As we're coming up to the end of the UK tax year, it is a good time to start looking at some tax efficiencies for your business. In the last week or so, we've got a couple of people coming through asking questions about the best way to take money out of their business. And these are limited companies, and the common sort of thing that they're seeing online in terms of advice, and indeed by using the likes of ChatGPT to get some answers, is that you should take a salary from your company of £12,570 a year, and the rest of the money you're going to take out, you should take as dividends. And I have to say, for most people, that generic advice does work well. But the truth is, it actually depends on your unique circumstances. So, for example, I've just been speaking to a potential new client who they might have income of somewhere in the region of 60 to 65k for the year ahead for a new venture that they've got. And in running a calculation between self-employment versus a limited company, the difference in their overall tax was going to work out at less than £100 a year. That's the way the UK tax system seems to be going at the moment. There's so much less difference between tax you're going to pay as a self-employed person versus tax you're going to pay as a limited company, and tax you'll pay as a shareholder when you're getting paid your dividends plus your salary as a director. There's just very little in it now. If you're not going to take, if the company or the business is going to be relatively profitable, there is benefits in going into a limited company. Certainly once you get above 50 or 60k of profits, it's worth looking at a limited company structure. But the tax side of it only works best whenever you're not taking all the profit back out of the company. So if the company makes a profit of 60k and it has to pay 9 or 10 grand of corporation tax, if you're not planning to take the rest of that money all as dividends, then a limited company structure can work well. But in general, what I'm seeing going forward is that at those kind of levels of money, there is very little difference in the tax overall between a self-employed person and a limited company. Don't forget, as a limited company, you'll pay corporation tax as the company on the company profits, and you as director and shareholder will be subject to tax on the salary of 12,570 you take out plus the dividends. Yes, you'll get the 12,570 tax free because that's covered by your personal allowance, but you'll pay dividend tax now of 10.875%. 10.75% for the year ahead, up to the 50 grand mark, and 35.75% above that. I would say overall, it really does depend on what your income levels are, but it also depends on what your financial habits are. The limited company structure works best when profits are higher and you're not taking all the profit out as dividends and you have good financial habits. So you want to avoid getting into a director's loan situation when you have a bad habit of using the company credit card or the company debit card for personal costs. Especially if you tend to buy things for home working. If you top up your heating oil or you pay your gas bill because you're working from home, turns out you'll not get tax relief for that type of expenditure. You will be able to claim something, but by doing things like that on a company card, it ends up meaning you end up with a director's loan situation and actually paying more tax on dividends to sort that out as well. All in all, you should be taking a bit of advice, run on some calculations before you make your final decision.